brief one. So Geanakoplos is the James Lane Professor of Economics here at Yale, where he started his career as an undergraduate before heading north to Harvard to earn his PhD.
Where you went?
Sorry, John?
Where you went?
Well, yeah, they're one of the premier mathematical economists of the 20th century, Keynote, whom, and I heard this from different sources, used to say that John was the best and brightest of his students, and I heard this from different people. And then he came back to Yale, and where he's been ever since. As you know, John started as a mathematical economist, as a general equilibrium theorist, so some of his early contributions are about thinking really hard about very complicated questions that, that later on will be used by all of us, and some of these include work on the theory of incomplete markets, work on default and bankruptcy, social security and overlapping generations, the theory of money, several contributions to different aspects of game theory. And sort of in the second half of his career, John has, as they're spending some time in the real world, has focused on other topics which are really relevant today, things like collateral equilibrium, the leverage cycle, the credit surface. I think we're going to hear about some of this today, and those are really core of macro finance as we understand it today. And we're eager to hear about what John has to tell us.
Thank you very much, Eduardo. I appreciate the invitation to speak today. So I'm going to talk about 15 lessons from financial crises. And I think it's good to have lessons in mind because we face financial crises all the time, and many institutions have to decide what to do in the middle of financial crises, and they often do the wrong things. If only they knew the lessons, they'd do better, and we'd all end up better off. Now, it may be that some of these lessons aren't true, so that's a disadvantage. So I'm going to present 15 lessons that sort of follow from my way of looking at the world, and I'd be curious to see whether you actually think they're true lessons. So I'm going to begin with two anecdotes, examples of what happened in the COVID crisis. My hedge fund, Ellington, that Eduardo just referred to, and what Yale, like many other universities, did during the financial crisis. So my hedge fund, we founded it 27 years ago. At the end of 1994, I had worked for a while at Kidder Peabody, which was a big investment bank, which went out of business in a crash in 1994. And then some of us from there formed the hedge fund, and it's been going for 27 years. So the hedge fund's done pretty well. These are the returns over the years. It's 10% annualized return. I'm only saying this to build a little drama there's a lot of effort that I put into it, and a lot of my time and a lot of thinking. And that's the same return that Swenson, the fabled manager of the Yale Endowment, exactly the same return he got over those years, 10%. And you can compare it to the S&P and a bunch of other stuff. And this goes up to the end of just before December 2019. I'm going to continue it right after. That's when COVID began. So one thing that's interesting is you'll see that there are some crashes. It began with the crash that 1994. It's called the derivatives crisis. But it does when Kidder Peabody went out of business. But then in '98, that's when long-term capital went out of business. You see the blue line, Ellington, went down by a lot, 20%. And then you'll see in 2008, it went down another 20%. And you're going to see what happened in 2020. And another interesting thing to see in this data is that if you look at the red line, that's the red line is emerging markets. And that has nothing to do, we invest mostly in mortgages and lately in corporate bonds because they're securitized and tranched and complicated capital structures. So we try to exploit, people's confusion about how the cash flows are working. So the drop in emerging markets, which has nothing to do with mortgages, happened in '98. It happened again, just almost the same loss in 2008. And it's kind of interesting how these unrelated markets can become very correlated in the crisis. So, all right, so here I'm going to continue the story. 10% of Ellington, so it's a $12 billion, it was a $12 billion hedge fund, and 10% of it was publicly traded, so you can get minute-by-minute prices compared to those numbers, which are the monthly markings of, banks that mark our positions. So, over 25 years, they're probably accurate, but, even month by month, you can't completely trust what those guys say, but over the long run, of course, it has to be more or less right because everything gets sold, over the long run. So here we've got the market. What does the market think everything's worth? And this is the 10% of the company. And you see the return, we pay 8% dividends. And so this is kind of a similar 10% return. It's like a 1%, return plus the 8% dividend. So what happened in 2020? 80% drop in the value of the publicly traded stock. And you might think that's an accurate reflection of what people think the value of a company was. 80%. That's a terrifying thing. If you've spent 25 years trying to build a company and you suddenly lost 80% of it, and most of your money is invested in it because you have to do that to tell the investors that we're paying attention. And so 80% loss. Now part of it was because the public thought that we were lending mortgages. We lend to a lot of subprime type borrowers because that's the opportunity. After the crisis of 2008, as we'll see, they almost got cut completely out of the market. It's very difficult to get a loan. So we would give them loans, and maybe the public thought that they're all going to default. Maybe the public thought we weren't going to make our margin calls. But anyway, 80% loss, terrifying loss. Now, volatility shot up. So in 2008 it shot up, in 2020 it shot up to almost the same level. This is the daily volatility. If you look at monthly or 2-monthly volatility, you won't see such a spike. But at daily volatility, it shot up to the same 80% levels as in the 2008 crisis. So this meant that if we're down 80% and volatility is that high, we could easily go to zero. And if you go to zero, you lose all your investors' money. You're bound to get sued. And if you get sued, you're going to spend the next 10 years in court. And so this was a very terrifying moment. And so we had to ask ourselves, should we try and conserve cash by laying people off? Should we tell, this is March 2020, should we tell all our, I'll go back to where this, shall we tell all our summer interns who are expecting to come in 2 months? Should we tell them, forget it, look for another job, we can't hire you? Should we lay off our secretary? Should we cut everybody's salary? Should I let my housekeeper go? What should we do? So we did nothing. We just hung on and did nothing. So all right, so we did nothing. Now, let me introduce this risk that we ran, which was the margin call risk. So, of course, you all know, but I'll just repeat it. What does leverage mean? If you have a $100 house or security and you borrow 80 and put 20 down, it's 80% LTV, 20% margin, 20% down payment. The collateral rate is 100 over 80, 125%. The leverage is 5 because $20 got you a $100 asset. Okay, so everybody knows, since the time of Shakespeare actually, that if you're leveraged 5-to-1 and your asset goes down 1% to 99 and then you pay back the 80, you're left with 19 out of 20, so you've lost 5%. So the leverage also shows how risky your position is. And my first student, Anat Admati, and Martin Hellwig became quite famous by arguing that this extra leverage that banks had been taking on, it made them much risky, and if there's an externality to banks defaulting, that's very dangerous to the economy, and we should limit leverage in banks. So my lessons aren't going to be that, because that I think is well known. They're going to be different from that. But anyway, that is an important lesson about leverage. So what happened to our margins? So this is the average of all our, tranched type securities. Not everything we own, but all the tranche type things. So it was 20% margins, 20% down payment. Then suddenly, almost overnight, in March, it shot up to 100%. So if we borrowed $80, let's say that's 20, to buy a $100 security, and the asset price, by the way, the people marking the assets said they were down 20%. The stock was down 80%. So let's say the asset was, let's say the price had really gone down 20%. We would have had to put down $16 of margin. It would have been a $16 margin call to keep the same LTV as before. The point is that the margins didn't stay the same. They shot to 100%. So that means if the assets had gone down to 80, we would have had to come up with $80 of cash, right? Because we're borrowing day by day in the repo market for all the things that we're buying. So we would have had to put up $80. So the fall in asset price causes a margin call on the order of $16. The change in margin makes the margin call $80. It's the margin change effect dwarfs the fall in asset price effect. So it's the sudden change in margins that completely jeopardized our survival, and which probably led to the markets thinking that we were down 80%. So that green line, however, is what happened to our margins, because we had done a lot of things to guard against this possibility. So so some of the things that we did, I guess I can read it here. So one thing is we negotiated margins of 6-month duration. So they weren't allowed to say, oh, the world's gotten more dangerous, we want to change the margin. They couldn't do that for 6 months. We had to pay a slightly higher interest rate to do that, but we always timed our 6-month contracts, when there wasn't much going on, and so the interest rate wasn't much higher. So we had a 6-month contract, the margin couldn't change. Another very important thing is, what exactly is the margin? It's the ratio of what you're borrowing to the market price. How do you know what the market price is? Probably nothing's being traded. So we worked out in our contracts, we were talking about this at dinner last night, in our contracts we worked out a deal where they have to say what they think the price is, our lenders, and then we get to challenge it. And we say, well, we'll sell one of our securities and we'll see what the market price is. So they can't quote some price that someone else is trading at or that they know about that we don't know about. We have to run a controlled experiment where we sell and we see what the price is. And so that's a very important, when people measure historically in the data, some of you are even doing it now, what the margins are, there's a lot of confusion about what the price is in any of these crises. So our contracts allowed for that. We also forecast exactly, who is going to make a margin call when. So we had all this stuff, and we had lines of credit with our investors. So we had prepared, having been through so many of these before, we prepared a lot of stuff, and we were ready to, to try and survive. So the lesson here, so we did survive, as you'll see in a second, but the lesson is, don't just sell cautiously, don't lay off workers, don't make irreversible choices. If you can hold your position, stay the course. Okay, now let's contrast this with what Yale did. Yale had $30 billion, not $12 billion, and it was money that couldn't leave. Our investors were all threatening to leave. Yale's money is permanent, $30 billion. What were they down? Well, the stock market was down 25%. So they all, okay, we were marked down 20%, so that's the same amount. In addition, they had these COVID expenses. How big were the expenses? $200 million. $200 million is less than 1% of the endowment. And the daily fluctuation of Yale's endowment is probably more than $200 million. So on the basis of less than 1 day's fluctuation in the endowment, they decided this was a crisis. And what did they do? Just like every other university, they froze faculty salaries, they stopped graduate admissions, they cut spending by 5%, they squeezed everything out of every department. So I happened at this moment when this was happening, I was chair of the faculty senate while my hedge fund was going down the tubes. And so the faculty senate, we made a lot of declarations. We said, stay the course. This is crazy. In fact, this is a great opportunity. We should be hiring more, not hiring less. When everyone else isn't hiring, this is the time for us to hire more. We've got this huge endowment. We can borrow. This is exactly when we should be using it. We sent a petition, and 70% of our faculty signed a petition asking the administration to hire more as opposed to hiring less. Okay, so obviously they ignored us and froze everything. So what happened? A couple months later, we heard in the first talk, the Fed intervened, all kinds of things happened, the margins went way down, and our 6 months was starting to wear off. So you can see that it's a good thing for us that the Fed intervened in time for the margins to go down. And so, because eventually our 6 months would have been over, but it did come down. And what happened to our stock? It went back and went back higher than it was before, and now we're a $14 billion hedge fund. So so this was the fourth crisis I've been through, and I decided maybe it's time to draw some lessons, and hopefully lessons that people like Yale can use. So I put together here are the previous crises. I said it already, the Kidder Peabody going out of business. That's when I heard everybody said collateral all the time. The word collateral came up over and over and over again. And so that's when I just started writing about collateral equilibrium and the credit surface. And then there was Kidder Peabody went out of business. And then Ellington nearly went out of business with long-term capital. And that's what led me to the leverage cycle. And then, in 2008, I started thinking about debt forgiveness. And inequality generated by the credit surface. And then I tried to help with the Greek debt negotiation. That was a disaster. And then, then I've been working more on empirical stuff with Rappaport that you can hear a little bit about. Okay, so here are the 15 lessons. All right, the first is a crisis is an opportunity. If you can borrow, or if you're wealthy, you shouldn't, hunker down and stop everything. On the contrary, it's an opportunity that you should make something of. And the fortunes have been made during crises. And I'll bet, I don't know this, but I'll bet if you look, even the market, not just the wealthy, but the whole market probably must have a higher Sharpe ratio starting from the depth of a crisis than it does at every other time. Most my colleagues in the economics department, they said, the world's more uncertain. Precautionary savings tells us that Yale should cut back on spending. And, and this is such a disaster that, how do we know it's not going to be permanent? Well, it could be permanent, but also things could reverse. In fact, the chances are that things are going to get much better because in crises, if you've got enough money, you tend to do very well. And precautionary savings is a very tiny effect. I'll come back to that later. So that's the first lesson. Crises are opportunities, and rich universities like Harvard and MIT and all the people who've spoken here, those universities made a terrible error by squandering their opportunity. Now they're all trying to hire, but everybody's hiring together. It's impossible to hire anyone. The bidding's getting unbelievable. So, the second thing is that if you look at the theory, the long history of stories about crises and business cycles, it's almost entirely demand-centered. So people talk about animal spirits, irrational exuberance, risk appetite, and precautionary savings. They don't talk about, and what's the Fed supposed to do? Raise the interest rate or lower the interest rate to affect demand in order to stimulate the economy or slow it down. Well, as we heard in the first talk today, the Fed does a lot more than just raising or lowering interest rates. They intervene in a huge way and in a different way. So the third lesson, second lesson is that don't get fixated on demand. The third lesson is the supply of credit is a key factor in all these crises, or most of these crises, in many of these crises. And just like Shakespeare in The Merchant of Venice, the Merchant of Venice is the investor and borrower, but the play is really just as much about Shylock, the lender, as it is about Antonio, the borrower, Merchant of Venice. So it seems like it's about Antonio, but it's really about Shylock, because Shakespeare recognizes the lender who's playing the crucial role. The whole play is about a margin call, by the way. But anyway, the credit supply, the fourth lesson, is credit supply is driven by a fear of default. So what does it mean? People say tight credit tightens. Well, does that mean that the interest rate's going up or down? No, it doesn't. It means that if you're trying to borrow money, suddenly the lenders won't lend it to you because they're afraid you might default. It's not like they're raising the interest rate incredibly high. They're telling you that you might default. So at the riskless interest rate, they're not going to lend to you anymore. So default is a crucial thing to keep in mind in crises. Okay, now when you have the possibility of default, what's very interesting is that lenders ask for collateral or they make other credit terms. You might have thought they just raise the interest rate. If they think, you're risky, they'll charge you a higher interest rate. But no, they don't. They ask you to put up collateral. So you need an explanation. Why do they ask for collateral instead of just raising the interest rate? Well, collateral and other credit terms, not just collateral, there are other things we'll come to, they're more important than the interest rate in crises. And again, Shakespeare recognized this because his whole play is about a margin. It's supposed to be a comedy or a love story or a commentary on anti-Semitism. Of course, it's all that, but it's also about a margin call. And who can remember the interest rate that Shylock charged Antonio? I know you're all too young, you may not have read The Merchant of Venice, but in my youth, everybody read The Merchant of Venice in every high school. And you remember that the key thing in the loan that Shylock negotiated with Antonio is the collateral, which is a pound of flesh. Everybody remembers the pound of flesh. Nobody can remember the interest rate that was charged, even though that took 5 times as many pages to negotiate. So the next thing is, so if there are these two things, the interest rate and the collateral, how do you determine two things from one supply equals demand equation? It seems like there's a puzzle there. And so I'm going to resolve it with something that I call the credit surface, which makes the interest rate not just one thing, but a function of the loan to value, which is a function of exogenous things like FICO, but also a function of endogenous things like loan to value. So the interest rate should be a function of the endogenous loan to value. So what's lesson 7? Collateral prices get very high. Can get very high, especially they are high just before a crisis. So if collateral is playing a big role, this sounds very puzzling because other people have written about collateral, Bernanke, et cetera, Gertler, et cetera, and the Kiyotaki Moore. The first stories that they told about collateral was how, with lack of trust, you need collateral, but collateral is an imperfect replacement for trust. So even with collateral, there's not enough borrowing. And so therefore those activities that require borrowing are going to be underfunded. And so you would expect prices not to be as high as they would be in a first best level, and activity to be not as high as it would be in a first best world because borrowing is limited by the need of collateral. Yet prices and activity seems to get too high precisely because there's collateral. So that's the 7th lesson, that the need for collateral can cause a boom, overinvestment, overpricing, not just a crunch when collateral gets too scarce. So that requires a little bit of an explanation. So you see 3 of the things that have had the biggest booms in pricing have been housing, tuition in schools, universities, and taxi cab medallions. All of them were doing the activity enabled you to borrow. It was collateral for borrowing. You could say, I'm going to school, now the government's going to lend me money. You couldn't borrow if you weren't going to school. If you were buying a house, you could borrow. Without it, you couldn't borrow. And taxi cab medallion, the same thing. So uncertainty shoots up in crises. That's the 8th lesson. Every time there's a crisis, at least in my personal experience, there's been a huge spike in volatility and uncertainty. So that's the 8th lesson. So the 9th is when the world gets more uncertain, who is it that has the biggest incentive to act? Again, we're always focused on the investor, but the investor has got upsides and downsides when the world's getting more uncertain. Of course, if the world's getting worse, that's a downside, that's a different matter. But the pure uncertainty effect is a plus minus for the investor. The investor, and even if the investor is risk averse and quadratic, it doesn't affect what she should do. It's only a 3rd order effect of why she should change what she does because of more uncertainty. But the lender has no upside, the fixed rate lender has no upside, just a downside for more uncertainty. So it's the lender has the bigger incentive to act. You should expect lenders to act. So lenders are going to act much more quickly than investors. The 10th lesson is that when danger increases, you don't see lenders, this is related to an earlier one, suddenly raising their interest rates. What you see the lenders doing is demanding tighter collateral or tighter FICO or some other terms. So they change the terms much more than they change the interest rate. Changing the terms has the effect of lending less. You have to put up more collateral, so you're gonna end up borrowing less. They suddenly cut their lending. So that's true of banks lending to hedge funds. It's true of individuals depositing money in banks. They're withdrawing their loans. That's the rational reaction of a lender who realizes the world's more uncertain. Withdraw loans, okay? Not raise the rate. So, a very fashionable explanation now of the crisis of 2008, especially at Yale, is that it was a panic. Now this, of course, is a word that all regulators love to use, like Bernanke and Geithner. I'll come to this because, a panic isn't something that they caused, it's something that they cure. So they have no responsibility for having caused it. So if 2008 is a panic, well, they solved the panic. They didn't somehow let conditions go bad. But this has never really been challenged empirically. So, when the Titanic sank, it sank because it hit an iceberg. I'm sure there was a lot of panic of the passengers as they were going down and drowning. But the key thing was it hit an iceberg, not that they were panicking and tipping the boat over. So people withdraw their money because, I think, from banks most of the time, because they think the bank might suddenly go out of money. I withdrew my money from JP Morgan. I called the guy up, my personal broker, and I said, I'm taking my money out. He said, you're crazy. He said, no one's taking their money out. And I said, I don't care about other people. I think the whole bank is going to go under, and one day I'm going to wake up and they're going to say they're insolvent. So I'm going to move my money and split it among a bunch of different banks where I'm going to be insured. So I think people are taking money out of banks, even in general cases, because they think the bank is going under, not because they think they have to get there before some other guy. I didn't think any other guy was going to get there before me. I thought the whole bank was going to go under. So, but that's a question. What is the evidence that it's people running from mutual funds and running from banks because they're panicking, as opposed to the fact they just think they might suffer losses, which they never could have suffered before because there was so little uncertainty. So we need an empirical test of how much of the so-called run is due to people just prudently not wanting to face a loss, and due to the fact that they thought other people would take their money out first, and so they had better get theirs before the other people got theirs. All right, the 12th lesson is that short-term loans are dangerous. And I'm going to elaborate this if I have time. Short-term loans are extremely dangerous because it gives the opportunity for the lender to change the terms of the contract, and that's what's causing so many problems. So it would be much better if we have longer-term loans. So why do we have short-term loans instead of long-term loans? Well, it's not because the borrowers don't recognize the danger they're exposing themselves to. It's because the terms they can get are so much better for short-term loans than for long-term loans. The credit surface is much tougher on long borrowing than it is on short borrowing. So I'm going to come back to that. So now lesson 13 is that it used to be that everybody said that when the prices fall, you get margin calls. Margin calls cause prices. Prices falling cause margin calls. Well, I realized in 1998 that when it happened was there was a crisis. This is 1998. There was a crisis in emerging markets, and the world was looking a little more dangerous. Russia and et cetera, and Asia, and the world was looking more dangerous. So mortgage lenders suddenly changed the margins, and that led to the prices falling. So I realized that the causality works in the reverse direction, that the changes in lending standards affect the prices. It's not just the changes in prices affect, force you to put up money. You're having to put up money lowers the price. So that just doesn't happen during crises, it happens all the time. Lending standards affect prices. Modigliani Miller is just not true. And the 14th lesson is when a crisis starts, whose borrowing is going to be most affected? Well, if borrowing depends on volatility, and the standards, as you're going to see, depends on volatility, it's going to be the riskiest borrowers because they're now even riskier. The risk for them has gone up more than for anybody else. So you're going to see lending squeeze out the riskiest borrowers before it squeezes out anybody else. It's going to be, it's a heterogeneous effect on borrowing. So the credit surface is going to shift much worse for the low FICO people than for the high FICO people. And the result is going to be that crises cause inequality. So this is one of my mistakes probably. So I wrote at the bottom of this, it's not related to the low interest rates that are making the asset prices go up, then those are held by the rich, which was actually the explanation just given in the last talk. So probably what I'm saying is wrong. But anyway, I'm claiming that the inequality emerging after crises is caused by the fact that the low FICO people are cut out of borrowing. And so for years after that. And there's going to be a 16th one where I'm going to shift. All right, so I want to derive all these things from a theory, and then hopefully there'll be a little time for you to tell me some of these lessons aren't right, or maybe there are other lessons. But if there were really 15 well-understood lessons, you know, there are lessons for policymakers and also lessons for investors and the lenders. I think the world would function better if everybody understood what to do during a crisis. So, what caused the 2008 crisis? Well, the explanations, there are at least 3 of them that are very common and standard. They're the most, valued explanations. One is it was greed and dishonesty. That's the Big Short movie. It's all about everybody got greedy. The mortgage lenders got greedy. The credit agencies went crazy and decided they had to bless everything because they get more fees. Everybody got corrupt because there was such a gravy train, and this dishonesty caused all the problem. Another explanation is the one I talked about before, the panic explanation given by most of our famous regulators. So it's The Courage to Act by Bernanke. That's the title of his book. Geithner's Stress Test, Restoring Confidence. You know, it's a matter of everybody's confidence disappearing. Whenever there's a debt crisis, people say, leaders say, there's a crisis of confidence. Franklin Roosevelt said, you have nothing to fear but fear itself. Draghi said, I'll do whatever it takes. I'm going to restore confidence. So why does that happen? Anyway, that's an explanation that it's all a matter of a failure of confidence. And then there's the irrational exuberance. This is the Schiller explanation, that suddenly risk appetite goes down or goes up, and et cetera. So the explanation I'm giving is complementary. Now, of course, I think it's better than the other 3, but I can't say that it's more important than the other 3, but it's complementary. It's all about the leverage cycle. So when there's low uncertainty, the credit surface, I'm going to show in a minute, is very flat, makes it very easy to borrow, leverage goes way up, and prices go way up. Then if there's a little bit of a shock, so it's not so bad in expectation, but it's much worse in the tail, so the expectations of the tail get worse, and maybe average gets worse too, that higher uncertainty steepens the credit surface, and there's low leverage therefore, and the prices fall. And because you don't start with high uncertainty, you started from the high price, low uncertainty world that made the transition, the fact that you're already in a boom means when the high uncertainty starts, the economy is much more vulnerable. So that's the leverage cycle. What the Fed should do is intervene when it sees a flat credit surface from 2000 to 2008 and borrowing and leverage soaring, the Fed should have intervened. So I hold Bernanke and Geithner, et cetera, responsible for not doing that. It's not, I believe, just a panic that happened in 2008 that they saved the world from, or they may have done that, but they also missed saving the world before the crisis. And so when the credit surface gets too steep during the crisis, the Fed has to intervene again. And Bernanke, to his credit, was one of the first people to recognize that in a way. And in 2020, the Fed recognized it in a much bigger way and intervened all through the credit surface. Okay, and then I said before that the low FICO people are their credit surface isn't gonna flatten when there's an intervention by the Fed. So okay, so this boom-bust story, leveraged, that was mentioned by Minsky and Kindleberger. I always want to remember them. There was nothing mathematical to what they did, but they certainly thought about credit. So if you build a model of this, I'm going to do that in a second. And it's going to involve collateral and FICO. And a lot of people worked on collateral before the crisis, starting with Bernanke and Gertler. So Bernanke deserves a lot of credit for that. And then in 97, Holmstrom and Tirole, et cetera, and Kiyotaki and Moore. And then after 2008, almost everybody in this room has done something connected to collateral. Now what did I do that was different from the other people? I did things in general equilibrium, so it was looks like a general equilibrium model. I don't think that's valued very much, but for me, I think it's important to have a very simple general model. And then the thing I emphasized was the endogenous leverage, the margins changing. That's what I think is the key thing that happens in all the crises. And so, how does it change and why does it change? So then, I'm going to get to that. Then the limitations, and the third thing I emphasized was that collateral itself can raise the prices, raise investment, not just lower them compared to the first best. Okay, so the first puzzle is the one I mentioned. How can it be that supply equals demand determines the price and also the collateral? It seems like two things are determined by one equation. So that's how I began with the paradox, why I got interested in the subject. Now the standard story is that many stories have been told by people, some of you here, some before, some by Bernanke, et cetera. You could have just what have they done? They've had fixed maximum LTV, a fixed arbitrary value at risk. That's a more sophisticated version of a fixed LTV, because now when volatility changes, the margins will change. So that's an improvement on fixed LTV. Then there's just demand-determined LTV. That's the Geanakoplos and Brunemeyer. So it has nothing to do with supply. It's demand-determined LTV. Then there's the moral hazard problem, which a lot of people used, where the borrower might steal the money. And the trouble with that explanation is that in a crisis, when the returns are highest, that's when you're going to get higher leverage, because the borrower has an incentive to make the high returns and not to try and run off with the money. So it gives a backward explanation of leverage. But anyway, that's another important explanation. So mine's going to be completely different. And it's related to another puzzle. In incomplete markets, you assume exogenous promises. Well, does collateral help you figure out what those promises would be? So there's a question of a non-contingent promise, how big should it be, given the collateral, that's the leverage, and a related question, what should the promises be if they're going to be non-contingent? Can you endogenously explain that? So that's the first thing I did. I said, you should think of a promise as an ordered pair, promise collateral, and call that a contract. And so every contract should have its own price and its own supply equals demand equation. So the same collateral could back promises that are bigger and bigger, so that have more and more leverage. Each of them should be traded in the market with a price. Now, trade in the market doesn't mean actively trade. Maybe there's a price and nobody wants to do it, but it still has a market clearing price. That is the key idea. So a contract is the promise AJ and the collateral CJ, and it trades at a price pi J, and all of them are traded in the market. So the next thing is, so how do you explain what's traded? Well, here's the power of the theory. You let them all be traded. Every promise collateral combination, and you see what the market does. So you would expect, well, we'll get every combination traded, just very little, because there's a scarcity of collateral. You can't have the first best trade because there'd be too many trades, and there's not enough collateral to back it. So we know there's going to be less trade, but you'd think if you had every possibility, the scarcity of collateral would just diminish all the trades in every one of the promises, but it doesn't happen that way. On the contrary, what happens is just a very few contracts get traded, and the rest aren't traded at all. So I have to explain why that happens. So that's the first insight of the theory. So what is the model? And I can see I'm going slower than I thought, so I'll just say the notation without going through the details. So you have S states of the world, as usual. It could be many time periods. You have consumption, L goods in each of the states, so it's totally general. You have endowments in all the states, so people have utilities and endowments. And then the contracts, or the promises, and what are the goods at time zero, put up to back them. And of course, the point of collateral is that it's durable. So you have to have a function Fs that says what happens to every good at time zero in each of the states. In some states, the house is fine. In some states, it burns down, etc. So Fs tells you what happens. So that has to be an element of the theory. And so that's Fs. Okay, and so the equilibrium tells you the price of all the commodities in all the states. This thing doesn't, I didn't like that. Okay, the price of the commodities in all the states, the price pi of the contracts, what's actually delivered by each of the contracts, which is now endogenous because there's collateral backing it, and then what does everybody consume? How many contracts do they buy? And some of the goods are durable, so XH includes durable goods like houses you're buying, you're holding, and then theta H is the purchases of contracts and phi H is the sale of contracts. So theta H is the lender and phi H is the borrower. Phi H means you're selling contract J, so you're selling a promise, they're giving you money, you're borrowing. Theta H is buying the contract lending. Okay, so delivery, I assume the simplest thing, you deliver the minimum of what's promised. A is the promise, remember, times the price, it's the vector of goods, that's the promise, and then the collateral, C, becomes by durability a bunch of different things, and its price, that's what the collateral is worth. So if you promise more than the collateral, you just say, take my collateral. If the promise is less than the collateral, then you have to keep the promise. So it's the simplest possible model. Everyone defaults the same way. There's no need for pooling. Okay, so the budget constraint, I'll just end the theory with this. The budget constraint is given the prices of commodities and the price pi of the contracts and the expected delivery on the pools, what do people do? Well, they have to choose what consumption and holdings of assets and goods, X. They have to decide what contracts to buy and sell. So at the beginning, time zero, what they buy of goods plus what they buy of contracts has to satisfy a budget constraint. But if they're going to sell a contract, phi j, it's going to require collateral cj, and the total holdings of collateral have to be in their portfolio, x0 of goods that they hold. So x0 is that all goods, or some of them are durable, some of them aren't. If you hold a good like a house, you've got the house. You can get utility holding the house at the same time using it as collateral. So you have to hold enough goods to cover your collateral if you're going to make those promises. And then in the future, what you consume is less than, and so F is from your holdings, some of it's durable, so you're going to have those goods in the future, and then there are the contracts. So if you bought a contract, you expected deliveries DSJ, they're going to be equal to DSJ, and if you make a promise, because everybody's defaulting the same way, just the minimum of the promise and the collateral, everyone is going to, the expectation is going to be met if the expectation is given as the minimum. So that's equilibrium. Okay, so it's a very general model, and I won't bother with the rest of it. Now, what is the credit surface? The credit surface says, since in equilibrium, let's suppose you have only non-contingent promises, but for every collateral, you've got every non-contingent promise. So the bigger the promise, the riskier it's going to be. For a low promise, the collateral is a fixed collateral here, and you're making the promise bigger and bigger on the right-hand side. So if the promise is very small, the collateral completely covered, the interest rate is going to be the riskless interest rate. But once the promise gets beyond some point, you're going to start defaulting, and so the interest rate is going to have to be bigger. So that credit surface is what I'm talking about. The function, interest rate is a function of the amount of collateral. Okay, so anyone between A and B is credit constrained. If they want to borrow more than the same collateral, they have to pay a higher interest rate. So in equilibrium, people want to make all kinds of promises that aren't going to be enough. So they're going to be collateral to allow all the promises. So how do people get rationed? Well, first of all, it shows up that there are not enough promises because the price is going to exceed, at the top line, the marginal utility of delivering. So people think, I'm getting so much by borrowing, I can pay in the future, no problem, if I can just get my hands on that money. So they're credit constrained. Well, why don't they borrow more? It's because they have to put up collateral. So why don't they just buy some more collateral and borrow some more? It's because the collateral price PCJ, P, the price of the collateral, is bigger than its margin utility. The whole point is that because collateral allows borrowing and you have and you're getting extra utility out of borrowing, collateral gives you extra value, so its price is going to be bigger than its margin utility from the consumption. So that's why people, so the collateral price is higher than its utility, and that's what rations the borrowing market, because people aren't going to want to buy too much collateral because they're overpaying for it in order to buy. So that's how the whole market is rationalized. And when collateral gets scarcer, the collateral price gets higher, and the number of loans is going to go down. So so the whole point of this is that efficient markets fails. It's not true that everything is priced according to its payoff. Things on which you can borrow are going to sell from a much higher price. So the law of one price, state pricing, stochastic discounting, all that stuff doesn't hold. So 99% of empirical finance is done assuming no arbitrage, meaning Ross's state prices. But there are no state prices in collateral equilibrium. So I think it's a great opportunity to do some more empirical work when things can be used as collateral. All right, so the collateral price boom, why is there a price boom? Well, as I just said, collateral is going to have a price higher than its margin utility, and in some cases that can be much higher than the efficient level. And you can see it easily by thinking of this experiment. If you want to borrow and you have a house, you can borrow. If you want to bet on the world getting better and housing prices go up and there's not arrow promises to use to bet, buying a house and being able to lever is the way you do it. You buy the house, you borrow a lot of money to make a huge profit when it goes up. So if you want to bet, you have to have a house. If you want to borrow, you have to have a house. And in Arrow-Debreu equilibrium, you don't need the house to bet, and you don't need the house to borrow, and so that extra demand for the housing is why it can have a much higher price. So it explains booms as well as crashes. And so the credit surface being loose means you're in the blue credit surface instead of the red credit surface. Okay, so now just a theorem. I said that it's quite typical that when you have a lot of promises, a lot of contracts, very few of them will be traded. So I have a series of theorems like this, but the most interesting one is with my student, Anna Fostel, who's now a professor at Virginia, and what she and I proved, sorry, did I lose this? Oh, pressing the wrong button. Sorry. Okay, what she and I proved is that take the red credit surface. So that each point on that credit surface represents another contract, more lending with the same collateral. So no matter what the preferences are, no matter what the utilities are, no matter what the probability beliefs are, no matter how many people they are, no matter how heterogeneous they are, if there are only two states in the future, everyone will trade at A or to the left. Nobody will be trading beyond A. So only one contract of all the possible contracts will be traded. So that's how it gets, that's how collateral rations trading. It doesn't shrink every single contract by 50%. It eliminates almost all of them, and all the trade happens in one. So leverage is determined by that point on the credit surface. And when the world gets tougher, when it goes, volatility goes up. You'll go from blue A to red A. And borrowing will go down and lending will be withdrawn. Okay, so you see this in the real world. If you do any plot of volatility and margins, you see that the higher the volatility, the higher the margins historically. So the second theorem we proved, so this first theorem, by the way, is not that great a theorem, the Fostel one, going the wrong way. Not that great a theorem because it relies on two states of the world. And where did I say it? Okay, two states of the world. So I think it has a kernel of truth to it, but it's definitely a little misleading. It gets much more interesting with more states when you're spread all through the credit surface. And a number of people, some in this room, like Alp and Eduardo especially, and some of my other students, have made some very important progress on this question. But so when you, okay, but I won't talk more about that. All right, so Okay, so what is the story of the leverage cycle then? The story of the leverage cycle, I keep hitting the wrong, so I beg your pardon. Okay, the second theorem, Anna, Fostel, and I proved, is that in the simple binomial world where the asset only pays, you only care about the asset for its payoff. It's not like a painting you can look at, or it's a stock, a GE stock, and it pays dividends in the future. That's why you hold the asset. In that world with only two states, you can prove that the higher, no matter how many people there are in heterogeneity and all that, the higher the leverage up to the riskless, up to that point A, the higher the asset price is going to be. So if the interest rate stays the same and you raise leverage, you're going to raise the asset prices. So it's, okay. So the leverage cycle then, just to repeat it, is that with low volatility, there's going to be a flat credit surface. That point A happens, that's a function of volatility. I should have said that. It's a function of volatility, because where does A come? It comes when a bad state, you just promise as much as the bad state payoff is going to be. So if you look at the ratio of the bad state payoff to the price, which is sort of an average of the good state and the bad state, it's very connected to volatility or down risk. So as down risk increases, you go from blue A to red A. So volatility is determining the point A. So you find tremendous, there I do it again, you find tremendous evidence of this. Okay, so volatility goes up, margins go up, you find a lot of evidence of that. So we also prove that prices go up, and so the leverage cycle is just what I said before. Okay, but now it's got some backing of a framework and a theorem. And now this little bit of bad news, okay, this bad news that worsens the outcome but increases the volatility, the uncertainty in the future, that's not an unusual thing. That's what usually happens. When the S&P goes down, the VIX goes up. So that scary bad news, as I said, that's the kind of news that we often face. So I will have to skip this example, which illustrates everything happening too bad. I can't quite say that. And do I have to skip all this? Okay, so let me now say one more thing. You could add punishment to the model. So not only do you seize someone's collateral if they don't pay, you also punish them. They go to jail, and the punishment per unit of default is defined by lambda h. This was introduced by Shubik, Dubé, and me a long time ago. Actually, Shubik had done it by himself first. But anyway, so it's a punishment for defaulting. I think that is FICO. The punishment might be psychological. You lose utility if you don't deliver. Some people have a higher conscience than others. They're more likely to pay. Now, if you know that people have a high lambda H, that's a good reason to lend to them. So you would have to, so you see, you punish people for defaulting multiplied by lambda H. So you could include, expand the model by having this penalty lambda H, and maybe it's measured by FICO. So I expand the model to include both collateral and FICO. So now I want to take it to the data. I'm going to end with just a few pictures. I'll go very fast. So in the data, my student Kalikman first drew this picture, but David Rappaport, another student who's at the Washington Fed, has now got the Fed going, and they're going to be publishing these regularly, these credit services. So here's a credit service in 2006. It's for conventional mortgages, Fannie Freddie mortgages. You've got the loan to value from 50 to 100 on the one axis. You've got FICO, 850 to 600 on the other axis. So the high FICO and the low loan to value, that's the left corner, that's the best loan. And then the right corner with the low FICO and the high loan to value, those are the worst loans. And so you see that people, even in Fannie and Freddie, which are the safe, these are all the best people, best borrowers in the world, they face a credit surface. If they've got a worse FICO or a high LTV, they pay a higher interest rate. And in a crisis in 2008, it shoots up. But who does it shoot up for most? The low FICO people, because they're the ones who are suddenly more dangerous. Okay, so in the crisis, the whole thing is shot up. The whole level went way up, but especially that corner with the low FICO and high LTV people, that became a disaster. So now in 2016, you see the whole thing is flattened out for sort of good FICO people, but it's still terrible for high FICO, for low FICO people. So years after the crisis, up until 2018, they still had a terrible trouble borrowing. That's why Ellington's lending to them. 2020, still the same thing. Okay, so let's look after the crisis. Here's the percentage of Fannie and Freddie loans made to low quality FICO, under 700 is red. So it was 35% all the way up to 2018, and it dropped to 5%. So I'm not talking about the total loans, I'm talking about the percentage of loans the low FICO people got. They got completely cut out. The total loans actually didn't go down very much because the government intervened to make it easier to borrow. So the low FICO people though got totally cut out, and then it rose and rose and rose, back towards where it was before, and then COVID came and they got cut out again. Okay, if you look at subprime borrowing, that's the red, and prime borrowing, that's the blue, you see after 2008, at 2008 it totally disappeared. No more subprime. I was giving you Fannie and Freddie, which are all prime. So inside prime, the low FICO get cut out. The subprime outside Fannie and Freddie, they're totally cut out. And if you look at, okay, well, I don't know what the hell that is. Okay, if you look at subprime mortgage borrowing, okay, this is the non-QM, so that replace non-QM, replaced subprime. It's a kinder word. You see after the COVID crisis, that totally collapsed again. Okay, so the same for auto loans, all right? So the whole thing keeps happening. So you could look at the corporate bond credit service at 2007, it's completely flat. Then in the crisis, it gets horribly, the scale is totally changed. It shoots up, especially the bad credit rating people. Then it gets flat again, and it gets quite flat. Okay, so it got totally flat. And so the corporate credit surface went back to where it was before, but the mortgage credit surface didn't. So all right, so that's sort of my last point, I guess. I was going to add one more thought. Well, you can do this credit surface stuff for, for lots of different collaterals, and you could do it for Lending Club, and they're all very interesting how they move around. So anyway, the Fed is going to be producing these now regularly. So I think that the Fed should produce them regularly, and they are going to. And I think more than that, I think the Fed should be couching its language about what it intends to do in terms of the credit surface. They shouldn't say, we're lowering the interest rates to stimulate activity. They should say, we're lowering the interest rate because we think that's going to flatten and lower the corporate credit surface and get corporations to do more, or because they think it's going, which credit surface, corporation or mortgage, is it going to affect, and which part of which credit surface are they trying to affect? Okay, and I think more than that, they should try to affect different parts of the credit surface, not just act at the riskless end and hope the whole thing flattens because the riskless end has gone down or steepens or something. They should directly intervene in different parts of the credit surface. I had a PhD student who went to the London, the Central Bank of England, who made that argument in the model. So anyway, then you can do a lot of empirical things, which we're doing now, about what happens when the credit surface changes, who borrows less, who borrows more, etc. I don't have time to talk about that. So I think I've used up all my time. So I was going to say one more thing about Bernanke and restoring confidence in crashes, but I'll stop here.
Thank you, John. Any just a quick question before we, or should we take, yeah?
What about the credit surface today? Like, is this a different situation? There's house prices have been going up like crazy, but there's the sense that there's not the same deterioration in credit standards as in
well, one of the things that I think you probably know this, but I bet many people don't know, is that 20% of housing is bought by Blackstone and people like that. These big corporations, they buy the houses and they rent them out. So they, of course, can borrow at the easiest possible terms. So this happened starting after the crisis, by the way. Since the crisis, there's been a new player in the housing market, and that's changed. I would say that's changed the shape of the credit surface, because you got this huge potential buyers who are facing a very flat credit surface. They can borrow a tremendous amount at the lowest possible rates. And they're the ones making the purchases, not individual homeowners. So David Rappaport and I are trying to figure out how to incorporate that into his pictures of the credit surface. You just
Right.
give, yeah.
John, thank you very much.
Okay.
We have a special plaque for you. It's made Senior Fellow of MFS.
Well, I appreciate this. I was, figuring they would give me this before the talk, just in case all the lessons were wrong. But anyway, I'm glad you've given it to me anyway. So thank you very much. I appreciate it. I'll say one more word. I think macro finance really is the central field in economics. It isn't treated that way, but I think it's the central field in economics. It's got more to do, if you ask what is the most important institution in the country, it's the central bank. What gets more attention on the front pages of all the newspapers? It's macro finance. So I am particularly pleased to be a distinguished fellow of the most important society in economics.